While the internet was obsessed with the private jets and celebrity real estate seminars, I was looking at the math. As a licensed tax CPA in the state of Missouri, I don't see what most people see. Where others saw a real estate mogul teaching financial freedom, I see something far more disturbing. A $40 million house of cards held together by wire fraud, bribed government officials, investor money that was never invested. This is the story of Cesar Pina, the man behind Flipping New Jersey, the celebrity-endorsed real estate empire that promised investors 40% returns in 5 months. But here's what the seminars never told you. Those returns weren't coming from real estate appreciation. They were coming from your neighbor's investment. Today, we're performing a financial autopsy. We're going line by line through the federal indictment, dissecting the forensic evidence that reveals how a real estate business became a criminal enterprise. And by the end, you'll know exactly how to spot the next Cesar Pina before they take your money. Let's open the books. The indictment tells a story, but not the story you've heard. It all starts with something called a joint venture agreement. On paper, it looks legitimate. Cesar Pina's company would partner with everyday investors, teachers, nurses, people who trusted him, and promise returns of 20 to 45% within months. The pitch? We flip houses, you get rich, everyone wins. But when you're a CPA, you learn to read between the lines. And what the indictment reveals is textbook commingling of funds, one of the most damning red flags in financial fraud. Here's how it worked. Let's say investor A gives Cesar $100,000 for a property flip in Newark. That money should be held in escrow, used exclusively for that property, and returned with profit once the flip is complete. But according to federal prosecutors, that's not what happened. Instead, investor A's money was used to pay back investor B, who invested 6 months earlier. Investor B's money? That went to pay personal credit card bills, luxury car payments, and to fund entirely different projects that had nothing to do with their original investment. This is called a Ponzi scheme, and the math is simple. The moment new money stops coming in, the entire operation collapses. But here's where it gets darker. The indictment alleges that Cesar Pina solicited over $5 million for a single property, a property that only costs a fraction of that amount. That means he was selling the same equity stake 10, maybe 15 times over. Multiple investors thought they owned a piece of the same house, but only one deed exists. In accounting, we call this fictitious asset reporting. In plain English, he was selling air. And when you're dealing with real estate, air doesn't appreciate. But the Ponzi scheme was only the beginning, because when you dig deeper into the indictment, you find something far more sinister. Corruption at the municipal level. Cesar Pina didn't just defraud investors. According to prosecutors, he allegedly bribed members of the Paterson zoning board to fast-track approvals for a project called Old School 5, a multi-unit development that required zoning variances. Here's the forensics trail. Cash payments, luxury watches, and what the indictment describes as things of value exchanged for favorable votes. This isn't just fraud. This is systematic corruption, the kind that undermines public trust in local government. But the indictment takes an even darker turn. Cesar Pina is also charged with money laundering, specifically laundering what he believed were narcotics proceeds. Now, whether or not actual drug money was involved, the fact that he was willing to participate in what he thought was money laundering tells you everything about intent. As a CPA, this is what keeps me up at night. Money laundering in real estate is insidious because it's so easy to disguise. A cash investor from overseas, a consulting fee for services never rendered, a loan payment from a shell LLC that has no operating history. And when you combine that with commingling investor funds, you create a black hole where no one, not the investors, not the IRS, not even the forensic accountants can follow the money. That's dark capital. Money with no origin. Money with no accountability. Now, no discussion of this scandal would be complete without addressing the man who put Cesar Pina on the map, DJ Envy. As a radio host with millions of listeners, DJ Envy became the face of these real estate seminars. He vouched for Cesar. He told people to invest. And when the empire collapsed, he claimed he was a victim too. But here's where the forensic accounting gets interesting. Multiple investors have filed lawsuits, not just against Cesar, but against DJ Envy, seeking over $2 million in damages. The legal question is simple. Was he a victim or was he a participant? In accounting, we look for something called beneficial interest. Did DJ Envy profit from the scheme? Who signed the partnership tax returns? Who received distributions? Because here's the thing. If you're marketing a business, taking a percentage of ticket sales and directing people to invest, you're not just a spokesperson, you're part of the financial supply chain. And in cases of fraud, that makes you potentially liable. I don't know what DJ Envy knew or didn't know, but what I do know is this. Influence does not equal due diligence. And when you tell your audience to trust someone, you're vouching for more than their personality. You're vouching for their numbers. And if those numbers are fake, your credibility becomes collateral damage. So how do you protect yourself? How do you spot the next Cesar Pina before he takes your life savings? After reviewing hundreds of tax returns and auditing investment structures throughout my career as a CPA, I've learned that financial predators follow the same playbook. They just change the cover story. Here's the CPA's red flag checklist. 3 warning signs that should make you walk away immediately. Red flag number 1, guaranteed high returns. In real estate, a 40% return in 5 months is a mathematical impossibility, unless you're taking on extreme risk, using massive leverage, or lying. The average annual return on residential real estate is 8 to 12%. Commercial properties might push 15% in exceptional markets, but 40% in 5 months, that's an annualized return of nearly 96%. Warren Buffett, arguably the greatest investor of all time, averages about 20% annually over 70 years. So when someone promises to quintuple Buffett's return using secret real estate strategies, you're not looking at genius, you're looking at fraud. If someone is guaranteeing returns without explaining the risk, they're either incompetent or criminal, and you don't want your money with either. Red flag number 2, the vouch factor. Just because someone famous promotes an investment does not mean it's legitimate. Influence is not due diligence. Celebrities get paid to promote. Whether it's a direct fee, a percentage of investments, or equity, the recommendation is a transaction, not a testimonial. Before you invest based on someone's recommendation, ask yourself this. Have I seen the audited financial statements? Have I verified the property deed? Do I understand exactly where my money is going? If the answer is no, walk away. Due diligence isn't watching a PowerPoint. It's reading the operating agreement, verifying the LLC registration, and checking for liens or bankruptcies. If that sounds like work, good. Investing is work. Anyone telling you it's easy is selling you something. Red flag number 3, lack of transparency. If you can't see the HUD-1 settlement statement, if you can't verify the deed, if the investment is explained in vague terms like proprietary strategy, there is no investment. There's only faith, and faith is not a financial plan. Legitimate real estate investments provide a detailed operating agreement specifying your ownership percentage, an actual property address you can verify, and a Schedule K-1 at tax time. If someone says, "Trust me, the returns will speak for themselves," that's not protecting intellectual property. That's hiding the truth. Cesar Pina allegedly used vague contracts and commingled investor funds. That's not sophisticated finance. That's a shell game. Look, I'm not here to tell you to not invest in real estate. Real estate can be a powerful wealth building tool when done correctly, but it requires transparency, accountability, and honest math. Cesar Pina's empire collapsed because the math didn't work. It never worked. It was a story held together by celebrity endorsements in the hope that no one would ask to see the books. As a licensed tax CPA in the state of Missouri, I've seen this pattern repeat itself. The names change, the products change, but the fraud stays the same. They promise easy money, they sell a lifestyle, they prey on people who want to believe there's a shortcut to wealth. But there is no shortcut. There's only work, discipline, and honest numbers. So before you write that check, before you wire that money, before you sign that joint venture agreement, ask the questions, demand the documentation, do the math, because numbers don't lie, but the people who write them do. Stay liquid, stay skeptical, and always audit the story you're being sold. This is the Dark Capital. We'll see you in the next investigation.